Hey, this is Mr. Elmhurst. We're here with a middle school math lesson where we're going to take a look at understanding credit, see if we can't break it down into more of a simpler way or three things that we can focus on where we could really understand what's going on with credit. So, what is credit? So, when you put money into a bank as cash, it's labeled as a credit in the account, but that's cash going into the account. So cash that is credit deposited to your account increases the balance. But we're going to be looking at credit as cash. And it's based on the idea that cash is borrowed from an account. So cash is being borrowed for a period of time, but it must be paid back. So if we look at banks, we're going to look at the different accounts that banks offer. So if we look at cash-based accounts, and we took a look at that already as far as check registers and checking accounts, but cash-based accounts, we're going to be looking at checking accounts, savings, stocks, retirement. There's so many types of cash-based accounts. But for this lesson, we're going to focus on credit-based accounts. No, we're not going to get into home mortgages, auto loans, and personal loans, but we're mainly going to focus on credit cards. But all of these types of accounts have to deal with credit. So credit is an age-old concept. So borrowing money has been around for thousands of years, but credit scores have been developed a little more recently. The credit companies have been using complicated algorithms. We have variables and formulas to try to develop these different types of scores. So they use them for if you're buying homes, autos, phones, so many different uses, even furniture. So with these complicated algorithms, the FICO score is being generated, and then also more commonly known as the credit scores. So all of this stuff going on, what does middle school have to do? What does middle school math have to do with understanding credit? So what do they need to understand about credit? Well, credit can actually be summarized into three factors. And one of them we've already worked on, ratios. But then we also look at risks and reports. So if we look at these three factors, we can really try to break down what credit is. So the ratio that is involved in credits is the ratio, the money that's being borrowed and the money that is available, or the total, the limit. So it's the debt is how much is borrowed, and the credit available is the total amount. So the big question, the ratio is how much of that credit is being used. So that's your ratio. Then you look at the risk. So credit scores looks at the risk. Is it high risk or low risk to borrow this person some money? So, and then is it high risk or low risk that they're going to pay this money back? And the other thing that they look at is reports. How is all this reported? So you have credit history, and then looking at whether money is paid on time, how many accounts are out there, and then also how old the accounts are. So we look closer at the credit ratios, and most commonly we look at credit ratios as a percent. So credit scores are connected to the parts total concept that we have learned in middle school already. So what is the amount that is being borrowed? So how much money is actually being used? That is the part. And what is the total amount available, or the limit that is available to the borrower? So the max, if they borrowed 100%, how much could they borrow? So if we look at just an example, person A, let's say person A has good credit. They borrowed $1,000, but they have a $5,000 credit limit. So they could have borrowed up to $5,000. That's the most they could borrow on their credit score, their current credit score. So the ratio would be 1,000 out of 5,000. So 1 out of 5, 10 out of 50, or 100 out of 500. That simplifies to 20%. So 1,000 out of 5,000 means this person is using 20% of their available credit. So in comparison, if we look at person B, and let's say they have average credit. So they borrow $1,000, same amount, but this person only has $2,000 available either on that credit card. So they're still working on their credit scores, but the lender only offered them $2,000 as a max, and they borrowed $1,000. Well, that ratio is $1,000 out of $2,000. So that ratio is actually 50%. So person B is using 50% of their available credit. So they're actually using a higher amount of their credit. And person A is using a lower percent or a lower amount of their available credit. So factor one is the ratio, the credit ratio, how much is being used. Then factor two, credit risk. So you look at the scores. So credit risk is calculated using the scores. So the lowest score on the credit scale is 300. The highest score is 850. So it's a like perfect score. This person, if you give them money, they're most definitely going to give you that money back without any interest. So a low credit score means it is a high risk to give somebody some of that money. High risk means it's a low chance to get the money back. Low credit score, low chance of getting the money back. Generally, that is in a 300 to 550 range. So 550 is kind of starting to get into that fair range. So, but it's still lower chance of getting money back. A high credit score means that it's a low risk to give that person money. But a high credit score means it's a high chance that you're going to get that money back. So credit agencies, they're okay. If you have a high credit score, they know that they have a high chance of getting that money back. And generally that is 600 to 850. So the excellent, good to excellent is going to be around 750 to 850. So you want to stay on that high end as far as credit scores, so then agencies know they have a high chance of getting their money back. So that's factor two. And now factor three, the credit report or the history. So credit history looks at all the credit accounts for the past 7 years. Some of them even look at up to 10 years. So it's the payment history, whether you're paying on time or late. And it looks at open and closed accounts. Do you have a lot of accounts or do you just have a few accounts? So a person with low credit score is going to have short or no credit history. They're going to have some payments, late payments, either 30 days late, 60 days late, 90 days late. So, and then also the credit history is going to show that they're going to be using, if they got a low score, maybe they do have credit available, but they're using a lot of that credit. So they're maxing the available credit that can be borrowed. Now, the high credit score person is going to have a longer established history, 5 years, 10 years, 15, 20 years of history, open and available credit where they've been doing business. And the best, highest credit score is that you do not have any late payments. Everything's paid on time. And then you're using the minimum available credit. You can use your credit. You could still put $1,000 on a credit card if you have $10,000 or $20,000 available. That's not an issue. It's just you're using a lower percent of that available credit. So if we summarize this here real quick as a lesson summary for the credit. Credit is money that is borrowed that must be repaid, and usually it's repaid with interest. So it's a debt repayment. You got to pay it back. Credit has three main factors for this lesson for middle school. So those three main factors are the ratio of money borrowed to total money available, the risk as far as a credit score, and then also credit history, credit reporting. Okay, so understanding credit, once you understand credit and how it can work for you, yes, you're going to have time to develop this through high school and all into your early adult life. But keep in mind, you develop a positive credit history, maintain a high credit score. It's going to save you hundreds and thousands of dollars in the future in buying furniture, cars, homes, mainly from lower interest rates. So that's going to be money saved is money earned. So thank you for joining me for this credit lesson where we took a look at understanding credit for middle school math.